Welcome back, investors, to Ticker Time News. I am Adam. Thank you for joining me for the after-hour show. We've got a bunch to talk about. The market seems to be on a teeter-totter. Just which way are we going to go? Are we going to go up? Are we going to go down? What is it going to be? Is Russia going to come into Ukraine and start a war, and then the stocks are just going to sink? I don't know. I don't have a crystal ball, but we can at least talk about it, right? And try to understand this market together. Okay, now that I've said that, the most important thing about this live stream is what's on your mind. So if you do have a question, leave your ticker symbol, leave the ticker symbol and your question in the comments, and we'll go over it live during the show. I've got a bunch of stocks that I want to talk about and cover. I've got 3 deep dives I want to do, and then I also want to end the show talking about how options play into earnings season, right? How can the options market almost predict or give a very strong vote on which way the market thinks a company is going to go up or down based off of earnings? Are they going to beat earnings or miss earnings? And how high is that probability? Because the stock market is just a big game of probabilities. What's the probability that this or that will happen or not happen, right? Okay, so we're going to get into all of that today in today's episode. This is our 85th live stream so far, coming close to that 100th episode. I am very excited for that to happen. Okay, so today we are going to talk about why Cisco wants to buy Splunk, all right, and how this sheds a light on Splunk's valuation. Also, WEBR getting totally burned on its earnings. And then Treehouse Foods posts a bullish guidance signaling a turnaround for the company. This is an interesting one. And Treehouse Foods is a company that I think is under the radar of most people, which is good because it gives us a chance to dive into this company without a lot of attention on the company and possibly catching it as it's getting ready to take off. So we got that. And then, of course, as I mentioned, we're going to talk about how the option market, it really acts as a good gauge on the expected future movement in a stock during earnings season. So we're going to get to that as well. And of course, also, I want to end the video with, of course, catalyst for tomorrow. What am I watching for tomorrow? Why am I watching it? And what am I watching for? So we're going to answer those questions about what's coming up for tomorrow. So today, stocks did close mostly lower, with the Dow Jones down about 170 points. The S&P 500, it shed about 0.4%. And the Russell 2000 declined about 0.5%, while the NASDAQ was nearly flat. It was green sometimes today. It was red sometimes today, but it did end nearly flat. Now, this session, it was dominated by fears of imminent war in Eastern Europe. And of course, the anxiety over what is the U.S. Fed's next move. And then Russia's foreign prime minister, he came out and suggested that there may be a way to use diplomacy instead of going to war to try to defuse the tensions. A lot going on over in Eastern Europe. Also, the St. Louis Fed president also reiterated his call for a 100 basis point hike in rates by July 1st. Now, 100 basis points, that equals 1%. 1%. So 1 basis point is 0.01%, and then 100 would be a full 1%. So I know you hear me use the phrase basis points a lot when talking about companies on my deep dives, and you might hear it a lot out in the financial press as well. So that's kind of the ratio there. 100 basis points equals 1%. So seeing a 1% hike in rates by July 1st. That's a pretty big move. Now, 9 of the 11 S&P 500 sectors, they did close lower today. They were paced by losses in energy, down 2.2%. Financials down 1.1%. Healthcare down 1.1%. And real estate was down a even 1%. Consumer discretionary was actually up 0.6%, and communication services up 0.33%. Those were the two that closed higher. Now, oil prices today did top $95 a barrel, and that was up 2.6% at one point today. And the 10-year yield rose by 4 basis points to reach 2%. Now, I talked about this on Friday's episode. There is a wall for the 10-year yield at 2%. A wall. And it will take a lot of momentum to get the 10-year above that 2% because of that big wall there. It's a big line of resistance. So if it does happen to break through that resistance, then that could negatively impact the tech sector, right? The NASDAQ. But there is a very strong resistance wall at 2%. You know, give or take a couple tenths of a percent. But yeah. And actually, from that resistance line up a little bit higher to maybe 2.1%, there's a bit of a gap that could be filled in if it did happen to break that resistance. So, watching that carefully, making sure that it doesn't punch through that 2%. Now, with the 10-year yield sitting at 2%, you know, it's like the bond market is thinking the Fed is going to do everything perfect from here on out. The Fed is going to do everything perfect. And I just don't think the Fed is going to do everything perfect because the Fed is behind the curve right now. The Fed is late to the party. Just look at the S&P 500 here, which will I'll talk about this chart structure that's taking hold here, and it doesn't look good. It's a negative sign there. What are your thoughts on CROX and RBLX? Roblox, CROX. So let me look here. CROX. I forget what that symbol is. Crocs. I should have known it. I don't follow Crocs too much, but I can dive in here and look. Roblox, on the other hand, I'm very positive about Roblox. I do wonder, though, because gaming data came in a little softer for the previous month, but the sales of consoles has not slowed down month to month. It was still up for the month. So that's one thing that gives me pause. If gaming slowed down a little bit in the previous month. Roblox, I think, is an excellent company for a buy and hold for the long term. As far as short-term movements, it can be very volatile, and I know earnings are coming up. But let me look here at Crocs right quick, just because I don't follow Crocs too closely. CROX, let's see what they're calling for, and if there's anything here that we can use to help us out. Crocs, it looks like they're calling for $1.90 for EPS, and last quarter they did $2.47. The quarter before that, $2.23. But if we go back to Q4 of last year, it was $1.06. So it looks like things should work out, at least here on EPS. It looks like $1.90 shouldn't be too far out of reach based on historical data here for them. They're calling for 580.7 million as the estimate for revenue. And if we look here on what they've done so far, let's switch over to quarterly here. If we go back to last quarter, they had revenue of 625. Before that, 640, and then a year ago, 361. I think they could do it just based off of historical data here for them. Looking at their balance sheet, wow, that's been moving up. Uh, their debt to asset ratio a year ago was 71.5%, and it's been steady climbing. And right now, the debt to asset ratio is 79.78%. Sorry, those numbers are a little small there to see them. So that debt's just been climbing right up with them as they've been growing. Their cash flow here looks pretty steady. Looks really steady. Their operating income, 150 million last quarter, 196 million prior to that. A little dip in Q1 of 21 to 45 million, and then back up to 124 and 134. So cash flow looks pretty good for Crocs. The earnings beats, they're consistently rising. That's looking good. Let me look here at a couple of statistics. Let's see here. We've got our price to earnings ratio. The current is 8.5. So that's good. That's actually been going down a bit. It was 20.6 and 19.5. A year ago, it was 20.6. Let's see here. Price to sales ratio is 2.1, 2.91. So that's not bad. This actually looks like a pretty healthy company. Yeah, Crocs is a solid company. I would totally agree with your statement. They do look like a solid company. Just running through the metrics there for their finances, and this company looks really strong. I would imagine this downtrend that it's been in is more of a macro issue than a company specific issue. And let's see here. What do we have on the chart? They had a real nice base that they were building back here, January of 21, all the way through April of 21. A real nice base forming right here. Right here in this area. So, if it's going to continue to come down, not due to anything with the company, but if the macro environment continues to weaken, then, I mean, it looks like it's got some really good support down there, right about 75. And I'm just saying this as a low point. If the overall market continues to come down, that might be an area where I could see entering and starting a position. But as far as where it might go for earnings, man, with our current environment with supply chain problems, and looks like right there at 98, they're holding up 97. But with the supply chain issues, it's a flip of the coin for some companies out there. Let me look at the implied volatility for Crocs and see if they have any number here. So CR, CC, CR. Nope, I don't see them on there yet. Matterport's got a high implied volatility for their earnings. All right, there's Crocs. So Crocs has got a 12% potential move based on the options market, 12%, and their implied volatility is 78%, while their normal historical volatility is a 61%. So the options market is betting on a 12% move for Crocs on Wednesday when they report their earnings. So when their earnings come out, that's what we're looking at. Yeah. All right. So that can be interesting for Crocs. That's a pretty significant move if that does occur. And it looks like it could. I mean, all these signs point to everything being positive here for Crocs. Full year 21 revenue growth guidance maintains 2022 outlook. Oh, that's great news right there. Look at that for Crocs. On Monday, Crocs said it expects full year 2021 revenue growth of approximately 67%, up from its prior projection of 62 to 65% growth, and non-GAAP operating margin of nearly 30%. For Q4, the footwear maker anticipates revenue growth of approximately 42% and non-GAAP operating margin of 28%. For fiscal year 22, the company said that it continues to expect revenue growth for the Crocs brand, excluding Hey Dude, to exceed 20% compared to 2021. It also expects non-GAAP operating margin of approximately 25%, including the impact of air freight. So that looks really good for Crocs in their upcoming quarterly report. So hopefully we answered your question there with Crocs, with the data we were able to pull up on Crocs. So looking good, looking really good. Let's look at Roblox next. All right, Roblox. I love the company. I think it's got a lot of potential for this one. This is one right here where when you typically have this symmetrical triangle pattern, you typically get a move to the upside, but there is that, 2, 3, maybe up to 5% chance it goes the other way, and that's exactly what happened to it right here on January the 6th. Okay, let's see here. One thing about Roblox, there's not a lot to go off of. Like, we've got this area around $75 that they were really trying to use as a base area. It acted as resistance when the company first went live. It acted as support when the company started going through the summer last year and then into the fall of last year, and then went on that crazy run. But now it's down, broke down to new lows around 53.63 and been on a rally kind of mode going into earnings here. So let me hop over here and look and see what the options market says. Roblox is actually in the number 2 spot as far as options go. Their implied volatility is 102%, and their historical volatility has been at 86%. So it's looking for a big move. And right now, the 1-day move after the numbers come out is 17%. That's what the options market is projecting, a 17% swing, either up or down, whether it's a beat or miss. So that's a very substantial move. and it's in, and the only other company that is above it for tomorrow is Upstart. Upstart has got 132% implied volatility and a 21% move. So might want to keep an eye on that one too, for a potential big move if it does happen. All right, so Roblox here. Let's look here. It's unfortunate that it's been missing estimates, but I think that's more due to analysts not quite understanding the potential for Roblox and what Roblox is doing. You got the whole metaverse aspect of Roblox that I don't think any analysts really are taking into account. And you can look at these projections that they've made here. A year ago, Roblox 32 cents a share, and it looks like they're calling for a loss of 12 cents per share. So let me hop over here. RBLX. All right, so let's see what they're calling for. All right. So here's where we got a little discrepancy. We've got the terminal calling for a 7-cent loss on EPS, and TradingView is calling for a 12-cent loss. Revenue of revenue of $778.3 million in TradingView. Oh, that's weird. Okay. TradingView is still off here. All right, so we've got a little discrepancy here. The terminal is calling for a 7-cent loss per share. TradingView has in here 12% loss per share. And then in the terminal, we've got 778.3 million on revenue. TradingView 772.044 million on revenue. So a little difference there on what they're calling for. Unfortunately for Roblox, they have I don't know. I feel torn on Roblox because I know there's a huge potential. And I know in 5 years from now, 10 years from now, it's not really going to matter whether or not we bought Roblox at $68.32 or $75 or, $58. It's not going to matter in 10, years from now when the company has grown and the metaverse aspect of it has just completely taken over. I mean, there's a huge metaverse media category because remember, Roblox did the virtual concerts and just some incredible stuff, and that's what I see in Roblox. Short term, I think anything can happen with it. Now, I'm unsure. I gotta admit it. I felt comfortable with Crocs and what we dug up on Crocs, but I feel a little uncomfortable with Roblox. I don't feel sure, and I don't know if that makes sense or not. But I just want to keep it honest and not just BS if I have no clue what I'm talking about. I feel torn on Roblox. I really think it could go either way in the short term, but I'm very confident in Roblox over the long term. So I know that doesn't answer your question completely, especially with earnings tomorrow for Roblox, but maybe the implied volatility from options the options market. Maybe that can give you um, maybe a heads up. I just feel like I'm not giving you my best possible here because I'm so torn on it. And if we go through just what the analysts say, there was on February 14th, which was today, Bank of America reiterated Roblox as a buy and called it a technology and product leader in the metaverse. Okay, that's good. It talks about what are some of the things here? It's really just talking up the metaverse. It's in the early adoption cycle, the metaverse, that is. Roblox is a category leader. And Roblox is demonstrating for consumers, for developers, and for merchants what the term metaverse means. They expect online media companies to sponsor their own metaverse parties. They note that Roblox has no, quote, old media businesses to cannibalize, and that it invests 100% of its resources exclusively towards leadership on 8 well-defined metaverse criteria. The metaverse category could eventually become parts of social media, streaming video games, and revenue streams from advertising and e-commerce. So Roblox could eventually encompass more than today's investors can conceive. That's the part that I really, really agree with. I just don't think analysts can see the future that the metaverse and Roblox is going to play in that. So the short term, again, I just repeating myself here. I'm not confident on which way it could go short term. It's a growth company, so the macroeconomic environment is going to put pressure on that. The rates being increased is going to put pressure on that. So there's a lot of negatives that are coming after a growth company like Roblox. But just like all rallies eventually come to an end, all this inward pressure from macroeconomics will also come to an end. And then, of course, Roblox will be able to flourish. But I agree. Okay, I wasn't sure if I was getting my thoughts out there in the right way. Glad to see that you agree with that. So yeah, that's Roblox and Crocs there. Definitely feel pretty good about Crocs. All right. Any other questions? Just go ahead and pop them in there. I'd be glad to go over it. I'll hop back over here and just finish up with the market. The only thing I wanted to finish up on for the market, go back over here, looking at the S&P 500. A bunch of people have been pointing out a head and shoulders pattern on the S&P 500. And if you're looking for it, yeah, it's more like, all right, this red line here, this is the neckline right here, right? You've got this right here as a shoulder, and then you've got this right here as a head, and then this as another shoulder. And typically when that happens, you get a fall like that. So it's being pointed out that this resistance line right here, this red line, this is where the market may not be able to break above. This may be becoming a resistance level, and you can see it got there twice on February 2nd and then again on February 9th, and it was rejected both times it got to that level. And that was right about, what we're going to call that, 45.90, right around there, 45.90 for the S&P 500. And if it can't break above that, then it's going to continue to fall down and get lower. So right now, the way here's where we stand, I guess I should say, for the markets. The Dow Jones is the leader for the year, but it's down 4.9% year to date. The S&P 500 is down 7.65% for the year. And then both the Russell 2000 and NASDAQ are in correction territories again. The Russell 2000 is down 10% year to date, and the NASDAQ is down 11.9% year to date. So I think this is just the beginning of a bigger decline. And I guess what we could say is that not just a bigger decline for the Dow Jones and the S&P 500 to get to correction territory, but possibly even falling to the 20% level, where we end up in a technical bear market structure on the indices. I mean, myself, I think that the possibility for the S&P 500 this year, 7 to 8%. I think that's all we're going to be able to get out of it this year. The past 2 years have been really, really good. And I mean, we've been in a bull market for a decade now. So we're overdue and it's time. All right, gold was up slightly today. Yeah, you can get to it on TradingView just by typing in gold, and you can get it directly from the source. It's at 1870 right now an ounce, and it's actually, I'll call it flat for the day. Bitcoin, the last time I checked on, one thing about gold, since September 30th of 2021, it's been in an uptrend. It did have this real big blow up right here back in November of 21, and then settled back down. But it is in a trading range right now, and it today and Friday, it has broken out of that. I guess Friday it broke out of that, and now today it's sitting flat right up there at 1870, and it's just sitting there. There is a resistance line here, and that same resistance line is what caught gold right here. We'll call it the 16th of November. It tried to break through on the 18th of November, and it got rejected. So this is a really tough level. If gold can break this level, then I think we're going to go a little bit higher, because then the next point is going to be up here, all the way up here at about 1900, 1910. Okay. That's the next level if it can break out of this resistance that it's in right now. So that's a picture there for gold. Let's look at Bitcoin, BTC, USD. And I do believe Bitcoin, just in case anyone out there is your first time watching, I believe Bitcoin is digital gold. I think as time continues moving forward, and as we reach that end point where there can be no more Bitcoin produced, that's when the functionality of Bitcoin being a store of value is going to be at its peak. All right, so here we are. We're up 1.7%. That's better. About an hour ago, Bitcoin was flat. So we got 42,808 right now. You can see it's sitting right there on its 50-day moving average. Let me blow this up a little bit. This blue line that is coming down from here, and I'll change the color to blue to match it, but it's moving like this, all right? All right, so that's the 50-day moving average, and you can see 1, 2, 3, 4, past 4 days, it's been riding it, and it's also at price support here, right around $42,000. So it's holding up. It's above that 50-day moving average, which if it's above, it's bullish. If it's below, it's bearish. Just a simple phrase to remember about the simple 50-day moving average. It's a very important line that can share positive structure versus negative structure on a chart. All right, Ethereum, ETHUSD. And there is a link to a free account in the description for trading view. And you can see Ethereum, it's following the same pattern. But like I've been saying for weeks now, Ethereum is just moving in bigger percentages, like Bitcoin 1.7%, Ethereum today 2.5%, excuse me. So it's just moving in bigger percentages than Bitcoin is right now. But Ethereum is below its 50-day moving average. In the past 3 days, it's used its 21-day moving average as support. However, over the same past 3 days, there is a trend line here, an ascending trend line. And if I go out, we can see that line a little bit better. It's not breaking above that trend line. It is sitting under that trend line, and that's acting as resistance for Ethereum right now. And if we look, today's high was 29.66, and that resistance line is right at $3,000. And you could really put a little spread in there, 3,000 being the top and maybe 2,900 being the bottom, if you want to put a little range on that resistance just to give yourself a little buffer. So yeah, that's where it's sitting at right now, and it is under its 50-day moving average, which is a negative structure, and it's under that trend line. It would be great to see it pop back above that trend line, but let's watch and see what kind of movements we get out of it for Ethereum. But again, it's cryptocurrency. The Super Bowl was crazy. There was ads for different, we'll call it cryptocurrency, maybe exchanges would be the right word. But the Super Bowl was loaded with that. The Super Bowl was also loaded with a bunch of electric vehicles. Now, electric stocks today did pretty decent. If we look at Tesla, TSLA, I know we haven't run through the electric vehicle sector in several videos, but look at Tesla here. It was up 1.8% during regular session, flat in after hours, and it's really holding at this line right here. It's just moving sideways. And this pattern here of moving sideways, it's one that if you want to play the options market, there's a maneuver or an options strategy called the iron condor. And if you find a stock that's moving sideways, that iron condor strategy works really good if you're playing options. So just keep that in mind. Stocks that move sideways, there's ways to make money. There's ways to make money whether stocks go up, down, or sideways, quite frankly. But yeah, so I just want to mention that. And then if we look at Lucid, LCID, Lucid was also up today, 6.1%. A lot of EV talk during the Super Bowl. And the question that's posed is, why did EV stocks rally today? Well, the answer that I would give is that the Super Bowl was filled from start to finish with commercials highlighting new EV models and sustainability benefits. So the Super Bowl is why you see electric vehicle stocks rallying today. That, what I'll call, is a spotlight. It's expected to continue as more EV models hit the market. The EV sector is one that is primed to continue to see benefits. This sideways movement, you can see it in Lucid right now. Tesla has the same pattern. It's moving sideways. It's consolidating. Uh, People are trying to grow their position in it. Hedge funds are even finding more interest in the sector. It was reported that several hedge funds, including Soros Management Fund, they disclosed that they added shares of Rivian Automotive in Q1. So look at Rivian. RIVN is the ticker symbol for Rivian. It too was up 6.4%, 6.4% today, which is pretty big for Rivian, with it sitting down here so low at 62.65. Now, quite frankly, I think whether the stock is at 62.65, whether it is at $50, whether it's at $100 5 years from now, it's not going to make a difference. I think Rivian has a real opportunity to be a leader in the small pickup truck arena. When you look at the best-selling vehicle out there, it's a full-size pickup truck, Ford F-150. So there's, as long as Ford, GM can put together a solid, Ford's got the Lightning, and GM or General Motors has got the Chevy Silverado, electric full-size pickup trucks. They'll probably duke it out for who's number one among full-size pickup trucks. And then you've got Rivian will probably be the leader in the small pickup truck, right? And then Tesla has got the different sedan, different car options, different models on lockdown. Companies will just be fighting for second place. But going back to Lucid for just a moment, their shares are down 30% year to date. And short interest in Lucid, I believe last time I checked, is right about 16% of total float. So Lucid is one that's got a lot riding on it. Lucid reports earnings at the end of February, and hopefully they can provide an update on production to give us some sort of catalyst, because what we're missing right now outside of the Super Bowl commercials is we're missing some sort of catalyst to help move these EV companies forward. And earnings could potentially do it, especially if Lucid comes out and talks about producing and selling and delivering enough vehicles. And same here with Rivian, if they can do it as well. So obviously, we'll just keep an eye on that and see how it progresses. Progresses. I'll get tongue-tied on that one. All right, last one. I just want to touch on it real quick. Aurora Innovation. This was one of my favorites when it first came on the market. It is autonomous driving technology that they are first implementing on, your big rigs, right? Your big 18-wheelers. Well, Aurora, and if let me just go back here a little bit further. When Aurora first went public, and I did a video about Aurora, uh, probably around November 8th of last year. And then the thing just skyrocketed right after the video. It went from, what is this, a $9.90 stock all the way up to 17.77 in one day. It was a crazy move. But the reason I'm bringing Aurora up is because Aurora and US Express, and it's spelt with an X and then press. They announced a collaboration to explore the development of the Aurora driver with US Express operations. Now, it's a strategic collaboration and it's designed to fine tune Aurora's autonomous driver as a service product. It's going to take place, I believe, in Texas, where Aurora is at. And the Aurora Horizon is also another piece of technology that they're going to test. Um, Really, I guess, just for to find efficiencies, to find any problems, and so they can fine tune it, so they can deploy it at a commercial scale without any issues. Aurora also plans to leverage the intelligence of the variant, which US Expresses. That's how they digitally enable their fleet to identify where autonomous technology can have the greatest impact. So I think that's a great job there for Aurora and US Express. All right, moving off of Aurora, currently operating without a permanent CEO. We've got Splunk that I want to dive into. SPLK is the ticker symbol for Splunk. It was up 9.1% today off of rumors, right? Look at this on the stock chart where Splunk used to be. I mean, way up there, way up there. Over, let's see, right up to $200, over $200 there for a couple of days back in September of 2020. $225 looks to be its all-time high. Yep, $225 all-time high hit on the 2nd of September of 2020. And now it's $124. So it fell a long way. Its 52-week average or 52-week high is $176. So yeah, it's been a while since it's crossed over $200. Now, there was a lot of excitement for Splunk today, to say the very least. But I do find it interesting that it's operating without a permanent CEO. Why haven't they filled that CEO seat yet? Is it because they know that with the team they have in place, that they're just going to sell Splunk? Is that why they have not found a permanent CEO yet? It's a question to think about. And then today's news just adds to that layer. So, Splunk, let's just go with this, is it's in a transition period right now after moving its offerings to the cloud, like a lot of companies, right? Well, Splunk didn't always be a cloud-based company. So they're transitioning to be a cloud-based company. And it's also in this process changing its pricing structure. So this shakeup of both the executive and business model, it follows a string of disappointing results over the past couple of years that led Splunk's stock to dive nearly 50% from its highs back in 2020 that I just showed you. Now, against this backdrop, the company has landed on the radar of networking giant Cisco. Of all companies, Cisco, right? Ticker symbol CSCO. But Cisco offered to acquire Splunk for $20 billion. And this is all according to a Wall Street Journal report. Splunk turned down the offer, but Cisco's bid does highlight the idea that Splunk is undervalued. Given Splunk's recent slide in revenue growth to a range of 20% from 30 to 40%. And if you look at their right now at $124.97, they are valued at $19.84 billion, right? So Cisco offers $20 billion, and Splunk said no. We're worth way more than $20 billion. So a premium valuation for Splunk, it's just not warranted right now due to the things that I already talked about. However, the around 6 times forward PS, it looks quite low right now for a leading cloud software company that operates in a very healthy enterprise data analytics industry, right? So it's unclear whether Cisco, which was clearly looking for a bargain, will consider upping its offer. The company's initial offer does shed a little bit of light on a few items, like Cisco is no stranger to the M&A market, M&A, mergers, and acquisitions. In fact, according to its own website, it has made 7 acquisitions since May of 2021. That's a lot. Now, none of those acquisitions came close to the $20 billion price tag, underscoring Cisco's commitment to expand its software business. Cybersecurity and video conferencing via its WebEx platform are Cisco's primary software markets, accounting for about 30% of total revenue in fiscal year 21. Cisco is aiming to bump that figure up to 50% in fiscal year 25. The addition of Splunk would instantly boost Cisco's revenue by about $2.5 to $3 billion, taking its total software revenue to about 35%. The bid for Splunk totally reminds me of Broadcom's ticker symbol AVGO and their $18.9 billion acquisition of CA Technologies way back in 2018. At the time, it seemed odd for a major semiconductor company to branch out into the enterprise software space. Likewise, though, Cisco's interest in Splunk may appear A bit strange at first, but I can see the allure. Similar to the playbook that Broadcom implemented, Cisco is looking to bolster its recurring revenue streams. And I love that recurring revenue to make its business more resilient and predictable. Also, a higher mix of software revenue is definitely beneficial to overall margins. Although the supply chain disruptions that hurt Cisco in Q1, their revenue outlook, well, it'll eventually ease at some point, lessening its dependence on hardware and component sales, reducing third-party supplier risks. Cisco's bid for Splunk should be supportive for other big data software stocks like SolarWinds, ticker symbol SWI, and Datadog, ticker symbol DDOG. As the digital transformation continues, an ever increasing amount of data will move to the cloud, making data collection, monitoring, and even analytics an IT necessity for years to come. It's not really overly surprising that Splunk turned down Cisco's offer because signs are starting to emerge that Splunk is beginning to turn a corner. For example, its cloud annual recurring revenue, ARR, which I love, jumped 75% year over year to $1.11 billion in Q3 22. With momentum building, accepting an offer that values Splunk at 25% lower than what it was worth just 3 months ago doesn't seem rational. Perhaps Cisco could sweeten the pot, but even if a deal doesn't work out, this is still a bullish development for Splunk because it puts the company's low valuation and improving financial performance under the spotlight for all investors to consider. All right, that's my thoughts on Splunk and Cisco and what might be going on there. All right, next one that we're going to talk about is WEBR. They make grills, right? I love their grills. I love cooking on a grill. WEBR is the ticker symbol for WEBR. All right, WEBR. All right, it's been a while since we talked about WEBR, but we have before, late last year. But WEBR, they were up 1.5% during regular session, but they were down 1.7% in after hours. Their earnings report just wasn't so good. So WEBR is getting hit with a minor sell-off after the company missed earnings and revenue expectations for its Q1 earnings report. The grill maker ran into soaring supply chain costs that sliced gross margins nearly in half year over year from 43.6% to 22.6%. Then, to add to the pain, grilling, it's not in season in every country which WEBR operates except for Australia and New Zealand. And finally, sentiment today is not being helped by WEBR's prediction that conditions will not normalize in fiscal year 22. Digging deeper, WEBR posted a GAAP net loss of 19 cents per share, while revenues dropped 8.4% year over year to 281.3 million. Most of the decline was due to supply chain shortages. The Americas region saw sales decline year over year by 13%, and the EMEA region by 4%, while Asia Pacific sales came in flat. Now, when looking at revenues on a 2-year stack, Weber looks much healthier. America's net sales are still up 67%. 67%. EMEA, 126%. And then Asia Pacific sales are up 57%. Still, this zoomed out view paints two conflicting pictures. On one hand, the solid 2-year sales growth shows the strength of the Weber brand, which flew off the shelves during the height of the pandemic. It also indicates a potential issue for Weber going forward. Weber reached its peak popularity primarily because of COVID related restrictions that fueled demand for at home and outdoor cooking. Weber already reaching its peak in popularity is definitely a concern. Now, I think Weber's current issues are largely macro in nature rather than a problem of the company's fundamentals. Weber is still very much in a growth phase, domestically and internationally. For example, one of its core growth strategies is to accelerate its direct to consumer and e commerce sales, which could help expand margins. Another strategy involving upping its footprint within the global retail space, expanding its current presence at Besco. I was thinking of Best Buy and Costco and said Besco. Oh my goodness. But yeah, it could expand its footprint at Best Buy, BBY, Costco, COST, and of course Amazon, AMZN. And then finally, a potential catalyst stems from Weber's move to enhance its presence in China, which it's already building upon through its plans to open its first Weber store in Shanghai in 2022. Overall, Weber got burned in Q1 as supply chain costs leaped higher. Shipping container costs jumped from around $4,000 in Q1 of 21 to about $15,000 this quarter. And Weber does not expect the situation to improve much throughout fiscal year 22. It noted that inbound freight is likely to represent 16% of fiscal year 22 cost of goods sold, a 200% jump from 2 years ago. The good news is that Weber still commands pricing power given its premium brand. The company's implementing price hikes to help offset some of the inflationary pressure, which should help improve margins, especially quarter over quarter and over the next few quarters. To give you an example, Weber expects over 12 points added to gross margin year over year in in quarter 2. The bottom line, as Weber is trading about 30% off its IPO price of $14 a share, and at a reasonable 17 times fiscal year 22 earnings, it is a solid turnaround play, especially if macroeconomic conditions begin to improve. But that improvement may take a little while longer. All right, there we go for Weber. Next, Treehouse Foods. the company that you probably haven't heard of that you probably should. uh, okay, let's get into Treehouse Foods. It's THS is the ticker symbol for Treehouse Foods. And I love that name, right? Oh, I can think back to being a kid playing in tree houses on the farm. It was awesome. Totally awesome. But look at this gap up here today on earnings. 8.1% move. It went up, it tapped its 21-day moving average, and that was the lid for now for Treehouse Foods. But they shed a ton of light during this earnings report. And if you look at the RSI plus MFI, I mean, it was lighting up by this thing when it was sitting at $35 all the way down to $34. It was just saying buy this thing. But that's what the RSI and M or plus MFI is there for, to help give signals when conditions look like you should be taking a closer look. All right, Treehouse Foods. It's up nicely after the company provided bullish fiscal year 22 sales guidance. Yeah, guidance. The company expects sales growth of 11% year over year in fiscal year 22. That outlook crushed estimates totally, which is especially a big deal given the rut Treehouse Foods has been in over the past few years. Treehouse Foods also squeezed out a slight earnings beat in Q4, and its 1% drop in revenue year over year was better than expected. So, Treehouse Foods manufactures consumer packaged foods and beverages for private label use. It splits its revenue into two segments: meal prep, which is about 60% of revenue, and then snacking and beverages, about 40% of revenue. The meal prep division comprises food service customers, um, while the snacking division includes a variety of grocery stores, big box stores, and e commerce shops. Its private label food options tend to perform really well during inflationary times, especially when coinciding uh, with a shortage from brand names, right? You got your Pringles, but you can't get them because the store doesn't have them. So you go for an off brand item. That's where Treehouse Foods comes in. For example, in December, major food distributor United Natural Foods, ticker symbol UNFI, it mentioned that part of its revenue and its earnings growth was attributed to substantial off label brands where natural brand availability, well, it was low. Also, nationwide grocery chain Kroger, ticker symbol KR, stated that its brands are helping fuel sales growth and keeping margins in check as they offer customers a cheaper alternative that carries much of the same qualities as name brands, maybe a slight different taste, especially among a few items. Unfortunately for Treehouse Food, that same benefit has not been showing up in its financials. For example, Treehouse Foods has grown quarterly revenues over the past year. Meanwhile, gross margins fell 472 basis points year over year in Q4. Now, to be fair, Treehouse Foods recognized or reorganized about 2 years ago, selling off its snacks and ready-to-eat cereal business and consolidating into the two segments that it has today. Reorganizing can cause higher costs and it can lead to inefficiencies as management just shifts personnel around trying to get things to line up and work right. But it can pay off massively over the long run. This is why Treehouse Foods fiscal year 22 sales guidance is such big news. Given the company's guidance for 11% sales growth year over year for the year, the inflationary environment, well, that creation heightened demand for private label foods. And Treehouse Foods reorganization efforts might be starting to come together at the perfect time. Also, Treehouse Foods is a possible takeover candidate, as it is actively engaged in a strategic review process revolving around a possible sale of all or part of the company. The solid fiscal year 22, that forecast makes the potential for a buyer to come around all the more likely. The bottom line, the past few years have been challenging for Treehouse Foods. However, its Q4 earnings report signal that things could be starting to turn around. After multiple periods of shrinking sales, Treehouse Foods' fiscal year 22 revenue guidance is huge news, and it could act as a beacon for possible buyers to actively pursue taking over all or part of Treehouse Foods. With Treehouse Foods shares down about 30% from its 2021 highs, this could be just the thing to spur a turnaround in the stock's price as well. Okay, that's what I think. This is a neat one. I like this one. All right, let's talk about the options market and then we'll wrap it up. And the options market and how it can play on a company's earnings. So we all know the options market, it acts as a good gauge on the expected future movement in a stock. More specifically, though, the option market gives you an idea of how the expected volatility in a stock ranks in comparison to their historical volatility. You look for a stock that could see increased volatility. Use the options market implied volatility to determine the current expectations for a potential one-day move in a stock. And you can use it for a stock you're watching or even one that you're setting up for a trade. It's all up to you on how you want to use the information. Now, the options market in doing that, let's give you an example here. Upstart, it reports earnings tomorrow. It has the highest implied volatility out of companies reporting tomorrow. So its implied volatility is 132%, while its historical volatility is 101%. So there's a difference there. About 30% difference. which translates to about a 21% move in the stock if the earnings are positive. That is exactly what the options market is saying. Now, Roblox is another one. We talked about it earlier. Its implied volatility is 102%, and its historical volatility is 86%. Its potential move, well, that difference is 18%, and its potential move is 17%. So, something to think about there. Toast, another company that we've followed before, TOST. Oh, gotta get the cursor on the right one. TOST. It's another company that we followed when they went public. But for Toast, their implied volatility is 111%, while their normal volatility is 97%, a 15% difference. Now their expected move is 16%. So all very interesting for tomorrow. Upstart, Roblox, and Toast are the three highest for tomorrow. All right, Catalyst Watch for tomorrow. With lodging, or I guess I shouldn't, okay. With lodging away from home prices soaring by 20.5% in the latest CPI data last week, watch Marriott International, ticker symbol is MAR, Marriott International. It's been a slow mover, but it is moving up, and it just recently tapped a new 52-week high right here on February 11th, last Friday. So can it keep it up? And the second one to watch is Airbnb, ticker symbol ABNB, to potentially benefit from that. All right. Also watch Viacom CBS, ticker symbol VIAC, to see whether Netflix losing subscribers or Disney gaining subscribers, which one is the better gauge on subscribers, right? Okay. All right. That'll wrap it up for today, ladies and gentlemen. Thank you for joining me. Thank you for the questions. I love the conversation. And yep, we'll be back here tomorrow. All right. Thank you again so very much for watching, and I'll see you in the next video.